This is Bloomberg Businessweek. Insight from the reporters and editors who bring you America's most trusted business magazine, plus global business, finance, and tech news. The Bloomberg Businessweek podcast with Carol Massar and Tim Stenovec from Bloomberg Radio.
Hi, everyone. Welcome to the Bloomberg Businessweek Weekend Podcast. Big mega cap tech earnings. You know, those magnificent 7 stocks. Well, many reported results this week. That included Alphabet, Amazon, Apple, Microsoft, and Meta. Some disappointment, some mixed news, Tim, but it was definitely a focal point this week.
You know what else was a focal point?
Yeah.
Our first Fed meeting of the year. We're going to have more on that in just a moment. Also, a batch of economic reports in the U.S., including consumer confidence climbing to the highest since the end of 2021, U.S. job openings rising to a 3-month high, and yet fewer workers quitting. And then, of course, the closely watched monthly jobs report. All the details on earnings in the economy at Bloomberg.com and, of course, on the Bloomberg terminal.
There was a lot coming at us. Now, with that as our backdrop this past week, coming up this hour, we have a bit of an environmental theme. We wanted to go in a little bit of a different direction. Howard Ungerleider, who spent more than 30 years at Dow Chemical, working his way all the way up to president and CFO, he talks about that journey and addresses concerns about the industry's impact on the environment. We got a little bit real with him.
Yeah, we did. Hey, we also checked in with Callie Edgren, Senior Director of Sustainability at Ascent, on risks associated with PFAS or forever chemicals. Hear what she is keeping out of her household. Also, this is a fun one. 3-time NBA champion Rick Fox, he's now in the sustainable concrete business. That's kind of surprising.
Basketball player, star,
Hollywood
actor.
And then he's a cement man now, is what he likes to say. He stops by our studio.
He was really into it. It was really
good, yeah.
Really fun conversation. All right. All of that to come. We begin with the first Fed decision of the year. The Federal Reserve held interest rates steady for a 4th straight meeting and signaled an openness to cutting them, though Fed Chair Jerome Powell threw cold water on investors' hopes that reductions would begin in March.
The economy has made good progress toward our dual mandate objectives. Inflation has eased from its highs without a significant increase in unemployment. That's very good news. But inflation is still too high, ongoing progress in bringing it down is not assured, and the path forward is uncertain. Today, the FOMC decided to leave our policy interest rate unchanged and to continue to reduce our securities holdings. Over the past 2 years, we have significantly tightened the stance of monetary policy. Our strong actions have moved our policy rate well into restrictive territory, and we've been seeing the effects on economic activity and inflation.
We had a perfect voice to talk about the Fed decision. Frank Sorrentino, founder, chairman, and CEO at New Jersey-based and publicly held regional bank, ConnectOne Bancorp.
I think the Fed did exactly what we all in the banking industry expected that they would do. Inflation is still a concern of theirs. There's still some work to do on the balance sheet. They reiterated their stance that they are going to continue their QT program and continue to take dollars off their balance sheet. And they're going to sit pat with rates until they see data that confirms that inflation is absolutely under control. And with the strong employment numbers that we keep seeing month after month, they're not getting that data as quickly as everyone else would like to see it, right? Everyone wants to see interest rates come down. I think we're going to see them in this range of altitude for quite a while.
Well, that's exactly where I want to go with this, because you guys do a ton with real estate and construction and small business. So remind everybody about your business mix, exposure to sectors, and more importantly, what you're seeing out there right now and what you project to see in the next few months.
I'm not sure if it was the last time I was on or a couple of times ago, but someone asked me what I thought the economy was going to look like as we got into the end of the year and into 24, and I said robust, and everybody sort of lost it.
I remember that.
But that is the sentiment when we here at ConnectOne speak to our clients and they talk about business opportunities and the environment in which we're in. Everyone, I don't want to say they're bullish, but they're optimistic about the future. And yes, interest rates are certainly higher than where they were 2 years ago, 3 years ago, 5 years ago. But let's not forget that was an abnormal place. Zero interest rates really don't exist for any period of time in any economy. And actually, the interest rate environment we're in today, but for the inverted nature of the curve, is more normal than what we've seen in the last 10 or 15 years. So, look, I believe, and we have these conversations with our clients. If you can't make money in your business with a 6, 7, or 8% interest rate, a true cost of money, then something might be wrong other than the interest rates themselves.
That's interesting.
Our home builders are seeing that, our manufacturers are seeing that, and other segments that we're involved in are seeing that they can actually make money, they can attract good talent, they can get capital at these interest rates and still make money.
So that when you hear the news about New York Community Bank Corp, also another regional bank player, a record 46 intraday loss or haircut in its share price after reporting a surprise loss tied to a deteriorating credit quality and a cut to its dividend as it's getting ready to meet stricter capital requirements. Is that a one-off? Is this one of those folks who are like, why can't you make money in this environment? What does that say? And are you seeing any signs of that?
Look, I think there are a lot of things going on in that story that you would have to really parse and get under the cover of. They bought a large defaulted portfolio through the FDIC from Signature Bank. They are mostly a multifamily lender in the New York City market. They had a fairly good-sized office exposure. They are approaching or just over the $100 billion mark, which puts them in a different category from a regulatory exposure. So you add all of those things up. None of those things are actually a great place to be at the moment. You put them all together, I'm just not sure. I don't know enough and really wouldn't want to comment without having more specifics around all of those facts. But when you add that string of things up, it's no wonder that they're having some challenges in the marketplace today.
Because you know the sector so well, Frank, I'm wondering if you see the problems at New York Community Bank Corp spreading potentially to other banks out there.
Look, we've been talking for a long time about issues within the real estate space. And if you recall, if we went back 2 or 3 years ago, even before COVID, retail was a really bad 4-letter word, and anybody that had exposure in retail, we had to spend an inordinate amount of time. And we spoke on this program about retail exposure in banks. Today, retail is one of the strongest segments in commercial real estate.
Right.
It's renting. Some of the vacancy rates there are at the lowest they've been in 30 years. So, there's a constant refreshment when it comes to real estate and real estate uses. As we went through COVID and came out of COVID, office became a problem. All office? No, not really. Individual office spaces, certain types of office, B class, C class, maybe central business district office where vacancy rates were the lowest. So again, you got to really parse the numbers and dive into what's happening. Same thing now is going on with multifamily. Multifamily, everyone thinks is a problem all by itself, but it really isn't. It's where you have rent stabilized multifamily. So the banks that have larger portfolios of rent stabilized are going to have more issues and challenges.
Right.
And those that don't won't.
We talk about the different tiers of real estate. It's really important. Having said that, Frank, your company's shares also got caught in the New York Community Bank Corp downdraft, down 4.5% on that news as well. Here's a moment to say, are you seeing any deteriorating credit quality? Are you looking to cut your dividend? You raised it last year.
We just had our earnings call last week, and we announced that we were pretty optimistic about the year ahead, and we've had a track record of raising our dividend, and that we would likely be raising our dividend in this next quarter. Our credit is near pristine, like every other bank in the industry. There are one-offs, and by the way, here's another metric that people are looking at. Charge-offs for banks have been, forget about historic lows, they've been at zero, which is just doesn't make any sense for the banking industry. We are in the risk business. There should be a certain amount of charge-offs.
Right.
We're still not back to what's normalized charge-offs within the industry yet. When some bank, announces an extraordinary number, everybody suffers for a day or two. I don't think it's going to impact us going forward. We have a great optimistic business plan going forward. Our clients in our markets are doing well, and I feel pretty confident about what's happening in 24.
One last question. We can feel your confidence. 40 seconds. So consumer business side of your business, nothing. You're not seeing any kind of financial stress, and just very quickly, if you could.
Well, again, not seeing any stress is probably could take it a little too far. Of course, there's individual challenges in various places. And, look, banks need to work with their clients, and we're seeing that in a lot of places. But overall, when you look at the U.S. economy, you look at the employment rate, the fact that people have jobs, the fact that we're manufacturing everything here in the United States, the fact that, we have so much going on to the positive, I see a pretty bright picture ahead.
Well, listen, we always appreciate getting some time with you. Frank, be well. Frank Sorrentino, founder, chairman, CEO at Connect One Bancorp, joining us on Zoom from Florida.
You're listening to the Bloomberg Business Week podcast. Catch us live weekday afternoons from 2 to 5 p.m. Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business App. Or watch us live on YouTube.
Well, Tim, I'm approaching 25 years here at Bloomberg.
That's pretty amazing.
It's been a long run, a really great run.
Does it feel like 25 years?
Sometimes, and a lot of times, no. It's pretty amazing how fast it's gone.
Okay, well, it is a major milestone. I got to say, I'm not even at my 5-year mark yet, but I'm on my way.
That's still big.
Yeah, getting there.
That's gone fast. Well, one thing you don't see much of these days, spending much of your career at one company, and that's pretty much what our next guest did. He spent 33 years at Dow Chemical, ultimately becoming both president and CFO. Howard Ungerleider retired in November, and during his tenure, oversaw Dow DuPont split into 3 separate public companies. Fair to say, he's seen quite a few cycles throughout his career at the chemical giant, namely on the sustainability front.
Yeah, those 3 companies ended up being Dow, DuPont de Nemours, and Corteva. Lots to talk about. We wanted to start at the beginning and find out if he had a favorite moment during that 33-year journey at Dow.
Oh, my goodness. 33 years, it seemed like every year was something special. Certainly, the investor relations role that I did in the financial crisis, I took that role in April of 2008. We announced an acquisition, Roman Haas, in the summer. Lehman collapsed in September, and we all know what happened after that. So, the old adage of what doesn't kill you makes you stronger. I learned a lot about myself. I learned a lot about our great company called Dow through that period of the financial crisis. I
still love that you went there, because I always think that is a time when the CFO, that position was no longer about the earnings call or quarterly earnings report, only just that, but it became the CFOs kept companies alive and figured out the balance sheet and what they needed to do. And I just feel like from that day forward, CFOs meant something very different.
Yeah, Carol, I couldn't agree more. Actually, my joke at the time was there were no equity investors. Everybody was a fixed income investor. They all wanted to ask about credit and risk. Now, that's 15 plus years ago now. But I actually think you bring up a great point. The role of CFO, I really think, has evolved dramatically over the last 25, 30 years. If you go back into the 90s, the best path to the CFO seat was most likely treasurer, a deal maker, a lot of M&A experience. Through the early part of the 2000s, after Enron and Sarbanes-Oxley, it really became an accounting-driven, compliance-driven, control-driven role. And I would say really the financial crisis was the beginning of, I think, the evolution as CFO as co-pilot. I am not a pilot by training, but I use that analogy because I think it's really apropos. The CFO really has to be the co-pilot of the enterprise today. And you think about what a co-pilot does is they have to do everything that the pilot does. They have one fewer stripe on their shirt sleeve, but they have to be able to land, take off, talk to the crew, work with air traffic control, navigate the plane, engage with the clients or the customers or the passengers. They have to be able to do everything the pilot does. So really, CFO as co-pilot, I think, is what this generation of CFOs really needs.
Howard, I'm going to break a rule that I should not break, but I just can't help myself right now. I'm still stuck on this idea that, your grandfather would call you early in your career. And I just, out of curiosity, is there any chemical that you worked on or anything you oversaw while you were at Dow? Like, does this story come full circle that he would have used or that dry cleaners end up using in their process?
Yeah, 111 is the perchloroethylene. It's a product that Dow no longer makes, but it's not really a product that dry cleaners use today for environmental reasons. But back 30, 40, 50 years ago, that was the molecule of choice for most dry cleaners. So he definitely used that at the time.
But you said they're no longer using it?
Right, correct.
Is that how come?
In terms of environmental footprint, there's molecules that are safer today that are better for the environment and better for the clothes.
Well, can we go there for a little bit? Because we thought about this when we were kind of planning. It feels like one of the next industries already or will be on many people's radar is plastics, and really the chemical industry is role in this. And the report that came out earlier this month, I think Columbia and Rutgers, about the detectable plastic fragments in a typical liter of bottled water, some 240,000. We've been talking a lot about microplastics and nanoplastics and how they're so much more dangerous. I think about The Graduate, the movie, and there he is in the pool, and they're like, what are you going to do with your life? And they're like, plastics. So how are you thinking about, having spent so much time in that industry, about what's the constructive conversation to have as we maybe move forward to, and probably should move forward to, a continually cleaner world that doesn't impact our environment so much?
Yeah, and I'm not here speaking on behalf of Dow because I'm no longer with the company. But what I would say is I think where the industry is heading, and Dow is certainly right there front and center, is decarbonizing the value chains and driving for circularity. Plastics actually is the most sustainable alternative. It's more sustainable when you look at it on a total carbon life cycle perspective than paper, than metal, than glass, or other packaging substrates. The challenge is most of it today, unfortunately, is not recycled, and it goes into the landfill. And so by driving decarbonization, meaning reducing or eliminating the use of hydrocarbons to make plastics, using other materials as raw materials, as feedstocks, then driving circularity so that those materials, once they're transformed into a plastic or a polymer for packaging use or durable good use, don't go into the landfill, but actually get reused and recycled. That ultimately will really benefit the planet.
But does it not get recycled because it's just not cost efficient to do so?
Yeah, it's more cost efficient today, unfortunately, to use virgin hydrocarbon resins and virgin polymers. So what we were advocating, and what I would still support, is some kind of a market-based price on carbon. That's not something that currently is happening in the United States today. It is happening in other countries around the world. Canada, our neighbor, for example, does have a market-based price on carbon. And if you implement a market-based price on carbon, that will encourage and financially incentivize people to actually do that recycling.
But what about the idea of these plastics actually getting into our bloodstreams through microplastics, now nanoplastics? That's something that's relatively new to me, and we're just learning about now. How do you think about all that?
Yeah, I think we need a lot more scientific study. That's really, we need to let the science drive the answer. And I would say that's the biggest thing that we can do as a society.
So would you say there's not evidence for that at this point?
No, not significant. No. And, you try to use the best available data and analytics and tools and technologies to develop the right polymers. And there are many chemicals that used to be used decades ago, which are no longer used because we found much safer molecules in order to be able to deliver the products and the features and the benefits that we as consumers like. And I would just say that we've got to continue to do that as an industry and frankly, as a society.
Love that. In terms of what you do next, when you say impact, what do you want to do specifically, Howard?
Yeah, so let me start with what I am doing. So I've signed up as an operating advisor for CD&R based here in New York. I'm also on the board of Kyndryl, which was the IBM spin out of the managed infrastructure business a few years ago with Martin Schroeder and David and the team there at Kyndryl, and I'm enjoying both of those roles phenomenally well. Creating long-term value for all stakeholders is what I would say gets me very, very excited. Dealing with complex three-dimensional problems and challenges and working to create long-term value, not just for shareholders or the owners of a company, but really, and what I learned in my 33-year career is you have to invest and create value for all of the stakeholders. That's your customers, the communities in which you operate, and the citizens and the ultimate end consumers, depending on where you are in the value chain.
Would you consider going full-time in-house somewhere and as a CFO or CEO?
Sure, I would. I mean, I'm having lots of interesting conversations, as you'd imagine. I mean, I promised myself, a lot of the people that I've spoken with that I respect, you can say yes to every conversation, but don't say yes to anything full time for at least 6 months. Give yourself a little bit of grace. Give yourself 6 months to really refresh and hit the reset button. So I'm doing just that. I'm having lots of conversations, but I will tell you, I really am enjoying the CD&R folks. I'm enjoying being on the board of Kyndryl, and I'm really enjoying the conversations that I'm having above and beyond that as well.
Hey, Carol and I were talking earlier in the day about Archer Daniels Midland plunged 24%, the most ever in a single day, after the company suspended its CFO and cut its earnings outlook pending an investigation into its accounting practices. We should note that's what we know so far. There's no wrongdoing being accused of anyone at this point, but there is an investigation going on. Just as a CFO, a former CFO, how do you read into something like that, like news like that?
Yeah, look, all I know is what I read on Bloomberg on my phone on the way from the airport. So I can't comment on that specific issue. What I would say, though, in terms of being a publicly traded company or any company in the United States, U.S. GAAP accounting is the Bible. It's a combination of the Old Testament, the New Testament, the Quran. Pick your favorite religion. You have to abide by U.S. GAAP accounting. That is table stakes. Now, if all you do is focus on the GAAP accounting, then you're not likely going to create long-term value for stakeholders. But you have to start with GAAP accounting. It all starts and stops at GAAP accounting. You have to do that. So I would imagine, we'll see what happens over the next few weeks and months as that story unfolds.
This has been great because we've been covering so much that's kind of going on in our news, kind of some of the big narratives, if you will. Having said that, politics. How do you believe global CEOs, U.S. CEOs should be planning for the outcome here in the United States come November?
Look, I think businesses have to go through many different political cycles, right? If you're going to be successful over the long term, you're going to outlive an individual elected official if you're doing the service for the industry. When I think about 2024. Certainly the economy, what I heard Janet Yellen talk about the other day was that, declaring success and a soft landing. I hope she is right. I hope we are dealing with a soft landing. With that said, it's never been done yet. So what I would say to fellow CFOs out there or people who are running companies is, prepare for a choppy 2024. Prepare for a 2024 that looked a lot like 2023. I think for the most part, certainly in the upstream parts of most value chains, destocking is most likely over. You have to do scenario planning.
That was former Dow Chemical president and CFO Howard Ungerleider.
Still ahead on Bloomberg Businessweek, they are everywhere. They're highly toxic, and they're probably inside all of us right now. Nope, we're not talking about microplastics. We're talking forever chemicals, better known as PFAS. We stay on the environment with someone who is advising global supply chains on sustainability risks, such as PFAS.
Plus, a proprietary concrete formula made from recycled ingredients that removes carbon from the atmosphere. All of that from a former 3-time NBA champion and actor, none other than Rick Fox.
It's America. You can do anything.
It's pretty amazing. This is Bloomberg.
You're listening to the Bloomberg Businessweek podcast. Listen live each weekday starting at 2 p.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business App. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
From rainwater in the Himalayas to whales off the Faroe Islands to groundwater in Minnesota, PFAS, or so-called forever chemicals, have been detected in every corner of the planet and in the blood of almost every human tested.
They've been linked to an increasingly long list of health problems, including obesity, fertility issues, and certain cancers. And Carol, there's a very high chance we'll come into contact with them today. And the scariest part, they're almost certainly in our bodies already.
Yeah, it kind of freaks me out a lot. I know we talk about this a lot too. It's a terrifying thought for sure. So we wanted to understand more about PFAS and on an industrial level, what is being done about them. Kelly Edgren is Senior Director of Sustainability over at Ascent. It's a company that works with manufacturers to analyze their global supply chains and look for sustainability risks and how consumers are forcing manufacturers to change their PFAS producing ways.
Well, I do think one radical disruption coming from manufacturers is 3M discontinuing the manufacture of PFAS. And this is kind of forcing everybody's hand, right? Because if you can't get the parts anymore, it doesn't matter if you've designed them out or not, you can't make those products. So I do think we see some radical forces already affecting this change. And we'll have to see if some other chemical manufacturers follow 3M's lead and stop making those PFAS chemicals altogether. If you can't get the parts, it doesn't matter, if you're in the scope of a regulation or not.
Right. They're going to exit all PFAS manufacturing by the end of 2025. How big is 3M compared to some of the other players that are out there?
If you look at the NGO ChemSec, it's a Swedish NGO, they've looked at the top 12 PFAS manufacturers in the world, and 3M is on that list. They're not the largest one, but they have a very broad range of PFAS chemicals. Of course, they've been making them for getting close to 100 years. So I think it is going to have a significant impact because they have a lot of niche chemicals that they're manufacturing as well. And again, their downstream customers are not going to be able to get those parts anymore.
Okay, so the cat's out of the bag. We know that when it comes to PFAS. I always like to ask people like you who live in these worlds day in and day out, Callie, how you have adjusted your lifestyle to live in a world like this. I mean, are you doing certain things at home that you think all of us should do because you're aware of the presence of these chemicals?
Well, I do have my glass water bottle here that I drink out of. Yeah, I get asked that question actually a lot. So of course there's the pans. I've changed my makeup. I've changed my dental floss. Definitely trying to avoid plastic for a number of reasons, not just PFAS. There's a lot of other chemicals in plastic, right? But then there's some other things that there's just not alternatives yet. So I am waiting for industry to somewhat catch up. I no longer spray my winter boots with PFAS. So I just where you become aware of it, that's a choice that you can make and try to find an alternative.
Well, and I wonder if that's the first thing to do in terms of labeling, right? That if there is something on a product, we've done that with trans fats and different things, right? We're all very aware. Things like corn syrup, and just there are things that raise the awareness that if a consumer starts saying no, that's got to impact a company's decisions and their supply chain partners. Sure. Is that fair or?
Yeah, absolutely. And there's already a handful of state laws that are migrating towards this, especially for cookware. They're starting to require disclosure. In California, they have cleaning products disclosure rules. Of course, California also has Proposition 65, which has a few PFAS in it, and that has to be warned to consumers. So I do think that we're going to see more laws coming like that maybe we can't design it out yet, but we at least want to make sure that customers are aware before they buy the product what they're going to be exposed to. And I think we're going to see some growing state regulations along that line. You
have an inside view on what these companies are doing, Callie. Are they doing the right thing right now?
I don't want to speak to the past, but I do think that in the current regulatory framework, they absolutely are, at least certainly the companies that I engage with. I think it's important to point out that there are very few PFAS chemicals that have actually had laws written against them. And so what's happened in the past is the way companies were discharging maybe water from their processes that had some PFAS in it, they weren't doing anything that wasn't legal. And so I think the thing to note here is that our understanding of the hazards has changed, and we are looking backwards. We see things like Superfund is going to be adding some PFAS chemicals to it. So I do think there will be some reckoning coming, but it is important to note that most of those companies weren't actually, violating any regulations. We just are all becoming much more aware now of the hazards of PFAS.
What's the number one reason why we should be really worried if we let this continue at the current rate in terms of the amount of PFAS that are out there?
I think first off, drinking water, right, is a large concern. And so a lot of states are enacting laws to start remediation of that drinking water. There are ways that you can filter PFAS out, that's expensive, but there are ways to do it. And I see a lot of state laws that are really focused on drinking water, soil, and air remediation. And that's certainly going to help, right? Let's get it out of the water that we live with every single day. I think that, more awareness of things, even choices, like I don't make microwave popcorn because there's PFAS in those bags. So that education for people of knowing here's choices you can make
Didn't know
help.
that. Hey, where do we look to find this information?
I think there's a lot of great resources out there. I mentioned the NGO Chemsec out of Sweden. They have a lot of great information on where PFAS can be found, and that's a great starting point.
Our thanks to Callie Edgren, Senior Director of Sustainability at Ascent.
Sticking with environmental sustainability, when we talk about carbon emissions on our program and the path to net zero, Tim, we often talk about the impact of power generation, transportation, and food production. That consumes a lot of the conversations.
Yeah, but an area we don't often think about is one that is responsible for 7% of global carbon dioxide emissions. It's more than what is emitted from all the trucks in the world. That's according to the International Energy Agency, and something that surrounds us all, especially here in New York City. I'm talking about concrete.
It's why we're called here in New York City the concrete jungle. Now, someone who's trying to do something about this is a 3-time NBA champion.
He's also an actor and producer, and he's also the co-founder and CEO of Partana. It's a company that creates an alternative to Portland cement and made of recycled ingredients.
We're talking about Rick Fox, who joined us in studio. And yes, we had to know, what is a former basketball player doing in the concrete business?
It started as a call to service to my home country in the Bahamas on the heels of a hurricane disaster, Dorian, in 2019. We were displaced. Some 30,000 people were displaced. Homes were destroyed. People were swept out to sea. And outside of donating money from my Bahamas Relief Foundation, I decided to get on the ground and start to ask the question of how do we build more hurricane resilient homes, more sustainable homes, to dig ourselves out of the $11 billion of debt that we were in as a country because of the repeated storms. Now, I grew up as a kid in the Bahamas where hurricanes were our version of a amusement park at the time in the 70s and 80s.
Yeah.
It wasn't as severe as you see today. And those storms are more and more frequent. So for me, it was a call to service to try and find a solution beyond just donating money. And that led me to a search around 2020 when the world shut down. And we can rest assured, Rick Fox is not the material science behind the technology here. We'll state that up front here. I have a number of scientists and partners who have been innovating concrete for decades. They're the best in the industry. One of them had been Cement Man of the Year. Others are on the board.
Hold on.
Yeah,
Cement
there's
Man
such
of the
a thing,
Year.
right?
Yeah, I was not aware there was a Cement Man of the Year. Well, congratulations to him.
Yeah, no, it's nice to have that. It reminds me of my Shaq and Kobe days when you have some of the best in the business to work with. So they've been innovating concrete, and over the course of some 6 years of rigorous innovation, they got to this material, not only catching lightning in a bottle for multitude of times in their careers, but in the case of Partana, I met them at a point when they were patenting this formula and trying to get it from lab into a commercial state. And so I formed a company along with my founder called Bloomberg Global to bring that out of the lab and into the world.
Rick, tell us exactly what they're doing and what makes it sustainable and less impactful on the environment.
Yes, so the first thing that you may learn about cement as a binder in the production of concrete is that it takes an immense amount of energy to get to a clinker state, which allows you then to produce concrete. We are a plug-and-play solution without the heating and the emissions that come with the creation of clinker. We have 0 Portland cement in our production of concrete. We take upscale big industry waste, one product of it being from the slag industry, the steel manufacturing industry, which is slag, and another one being brine, which is the desalination industry, where those waste materials are pumped into the ocean or pumped into landfills. We take them and through our process.
And it can be devastating.
It can be extremely devastating. When if you think about cement and its impact on the environment, heats up our planet, then it heats up our oceans and destroys our coral. It's a repeated cycle of negativity, right? We get to a nature positive concrete by swapping out the binder that is Portland cement and replacing it with Partana. Those waste materials through our process and our patented formula get us to an interaction with CO2, which not only avoids the CO2 negative emissions when we produce it, but also absorbs and removes CO2 from the atmosphere
How
in
does
that carbonation
happen?
process. So
Don't trees do that?
yeah, trees do it.
But how does a building do it?
Yeah.
Like, it
Right.
makes sense that
So
a tree and its leaves do it.
Well, it's chemistry, right? So the magic of chemistry will generate the process through the interaction and activation of the brine in our mix. But even cement, the negativity of cement, it is also absorbing CO2. So let's not. The problem with cement is that it does so much harm on the front end that it can't celebrate the back end.
I mean, the actual manufacturing of it.
Yes, you can't celebrate the back end of it. And so in the case of our company, we had a 2-year close working relationship with one of the top manufacturers of cement products, Topworks out of Germany. They just validated us at the World of Concrete in Vegas as the only replacement for Portland cement in the concrete industry right now to date. Now, there are a lot of people out there reducing Portland cement in the production of concrete, but no one can 100% replace it, avoid and remove CO2 at the same time.
Who's backing the company? Venture capital was.
I give a huge gratitude and shout out to Cherubic Ventures, our angel investors that have been there from day one. They've brought a number of their network folks along with us, major individuals that have supported us. And now as we move towards this year, scaling being the next challenge, we're hoping to have the likes of some of the biggest movers in the world that can actually scale this.
Where are you right now in this? Like, how much have you raised?
Right now we've raised $30 million. So we're moving into this year now to scale 4 factories in different regions globally.
If it's so, sounds like win-win.
Yes.
It would seem to me that anybody who was in the building environment would say, I'm in it. Let us help you scale it up.
Yes.
Is it cost a lot to do this?
So prices, in terms of manufacturing and CapEx, building a facility is something that's not exciting to investors when you're burying CapEx dollars.
Yeah.
But once you establish that, then you have the ability to generate return on that investment in our factories in the first year. So we turn around rather quickly here.
So the actual product is competitive with existing building material or existing concrete.
Right. So cement is a commodity. And as you can imagine, different parts of the world, depending on where you get your materials from, cement can be priced slightly all over the place, right? No different with our formula. The exciting part of our business model is we become a plug and play. When you go to a factory that is producing cement products today to get to concrete products, finished products, we can swap that in and out in a plug and play fashion in less than a week. So the excitement level there is no new equipment, no new materials. You're really taking out the binder of Portland cement and you're adding our binder of Partana. So that's so when you talk about the cost,
right.
cost is relative, right? I'll just say this one point I like to remind people. You will pay, depending on your problem, that'll determine what you're willing to pay, correct?
Agreed.
And so in the case of our products and material, we're making affordable homes in the Bahamas, some 1,000 homes, all the way up to luxury-based developments. So whether we're making a CMU block or pouring a bridge or a planter or whatever retail product you can make, you're going to find a wide range of product and pricing. But for us, we hope with scale to bring our products down below what cement products cost,
right,
which we know we can get to. And then on top of that, we generate an asset class at a bottom line in carbon credits that can be used for good and actually can incentivize our partners.
This is one of those interviews. You're going to have to come back because we're running out of time and we know we want to do more. Good luck. Let us know how things are going.
Thank you.
Rick Fox, of course. We appreciate your time today. Partana.
You're listening to the Bloomberg Businessweek podcast. Catch us live weekday afternoons from 2 to 5 p.m. Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business App. Or watch us live on YouTube.
Plenty ahead in our second hour of the weekend edition of Bloomberg Businessweek from Bloomberg Radio, including giving up your smartphone for an entire month as part of a digital detox contest. Tim, can you do it?
I don't know if I could do it. It does have a $10,000 prize, so I might consider doing it.
It's a whole month, kiddo.
It's the brainchild of Siggy's Yogurt, and we had Siggy Hilmarsson on. He's chairman and founder of Siggy's. He joined us to talk about this, and yes, we also talked quite a bit of business.
We certainly did. Plus, the failed attempt of a fading hip-hop mogul to salvage his crumbling business empire. You may know him as Sean Combs or P. Diddy or simply just Diddy.
Plus, the Grammys are this Sunday. And yes, it's about Taylor, SZA, John Baptiste, Billie Eilish, Olivia Rodrigo, and more, but it's also about paying musicians more money. We check in with the president of the Recording Academy, Harvey Mason.
First up this hour to one of the most read stories on the Bloomberg terminal this past week, and it's in the new issue of the magazine on newsstands, online, and on the Bloomberg. The story is about the most expensive basketball arena ever built. How much, you ask? Well north of $2 billion, to quote the individual doing all the spending.
Okay, before we say who it is, here's some other numbers to chew on. The arena's got 1,160 toilets and urinals, 199 countdown clocks, a 44,000 square foot halo-shaped LED board, a floor-to-ceiling bank of 4,500 seats on one baseline, and one very enthusiastic and energetic team owner, none other than former Microsoft CEO, Steve Ballmer.
Yeah, there's a few videos floating around of him bouncing around on a stage or two, or in front of his
enthusiastic.
team. He's very enthusiastic. Bloomberg News Business of Sports reporter Ira Boudway flew out to L.A., put on a safety vest, boots, and a helmet to get a tour of the new Intuit Arena. It's the newest home of the L.A. Clippers. That, of course, is the NBA team owned by Steve Ballmer. Ira joined us along with Bloomberg Businessweek editor Joel Weber.
And what's really fascinating about this one is in Los Angeles, the Clippers have always been sort of second fiddle to the Lakers. When Steve Ballmer bought the Clippers for $2 billion, it started this process to really change the world's perception of what Clippers basketball will look like. The team is quite good, and beginning next season, they'll be playing in their own arena for the first time. He's a basketball junkie, and so his obsession with the stadium and the arena is, I think, this manifestation of that. And Ira got to, you got to wear a hard hat, right?
Yes.
With Ballmer.
Boots, vest, not with Ballmer.
Okay,
I was at Crypto.com Arena, where the Clippers currently play and share with the Lakers, with him. And then I got a tour with the team's president of business operations, Gillian Zucker.
Okay, so take us through like what this is going to be like as a fan of like what Ballmer is trying to build.
It's very interesting because he has a very distinct point of view with it. He wants all the fans basically out of their phones, locked in on the game, cheering loudly, providing a competitive advantage to the home team. He wants basically.
Why wouldn't you want that?
Yeah,
that sounds great.
Isn't that why you're supposed to go to a game?
Yeah.
I got a few $2 billion to build a place where that can happen.
But if you want to maximize revenue, arguably you put hundreds of suites where people sort of chill out and kibitz during the game. He's not going for that approach, and he sees this as an alternative to the Lakers, and as a kind of hearkening back to an old style of fandom where you were engaged in the game throughout.
Is the idea that revenue growth happens when the fans get more excited, the team gets better, and then the ticket prices go up? Or is he Steve Ballmer and he doesn't? He's one of the wealthiest people in the world and doesn't care?
He wants 17,500 Steve Ballmers there with him.
Okay.
He is incredibly enthusiastic.
Is he that enthusiastic in person?
In person, he's everything that you've seen in the sort of famous Monkey Boy clips online. He brings that energy, and I think he wants that energy in the arena, and that's his first priority. I think they think that's compatible with making it work financially, and that the part of the reason it can work for the Clippers is that they need to be an alternative in the LA marketplace. The Lakers are one thing. The Clippers are going to be, in his mind, the place for the basketball purists who want to be on their feet all game long.
So to build this, how did they go about finding inspiration?
They took ideas from all over the world, and everything was focused around the idea of, like I said, keeping people's attention on the game. So they have really limited concessions so that you don't wander the arena looking for your favorite item. They have
so there's like a consistency.
Yeah, it's like 8
hot
items.
Dogs are hot dogs.
Yeah,
Don't
it's
go
exactly.
looking for that
Yeah,
other one.
and the way they're setting up the checkout is this frictionless. You walk in, you take what you want, you walk out. They have these countdown clocks you mentioned, those 199 countdown clocks. Those are going to show people how much time is left in a timeout before they need to get back to their seats. Even the suites are set up so the seats are in your way. If you're standing in the sort of dining area, typically you can kind of lean on a counter and look out over the game while you're eating and drinking. He's got it set up, no, you got to get back out to your seat to watch the game, so you can't kind of multitask. And this wall is 51 rows of uninterrupted seats, no suites in the way, floor to ceiling, where you have to be a Clippers fan to get tickets. They're going to have a loyalty program where you have to post something on social media of yourself in a Clippers jersey or answer trivia questions in order to even get access to buying those tickets. And they want it to be like a kind of Cameron Indoor Fieldhouse feel.
I love that, but I also am just going to guess there's going to be such a program to try and infiltrate that space and just be like the one Lakers fan in the Clippers.
That policing that is going to be really interesting. You know, they're in
Steve Ballmer is going to be watching that like a hawk.
Does the NBA have any say in terms of arena, in terms of what needs to be done, or no? An owner can kind of do what he wants, especially when it's his money.
There's a set of standards, but it's pretty like, you know, you got to have so many seats and you got to have a certain level of amenities and stuff. But in terms of like what he wants to do within that, there's a lot of latitude.
Okay. You didn't mention toilets, which I mentioned at the top.
Right.
Can you talk about?
Definitely for the fans.
I'm sorry, Joel. I'm sorry. I wrote toilets. I want people to know I'm not the only one obsessed with toilets. Okay.
Right.
I'm sorry. You go ahead, Joel.
What was the number? How many toilets does this place have?
1,160, I believe.
Sounds like
was
a lot.
The last count. Yeah, they say it's 3 times the typical NBA arena ratio of seats to toilets. So, and again, the idea with that is, he doesn't want you standing in line. The Clippers don't want you standing in line when the game's going on. So they're trying to get you in and out as fast as possible. And so Ballmer, you know, was at the groundbreaking, did a reprise on his developers chant with toilets. The team, you know, they're like trying to get him to say fixtures and like rope it in a little bit. But, you know, it's just about basically he wants hopefully everyone watching the game for every second.
Are ticket prices going to go down? It sounds like this is all about for the fans. Do prices go down?
Prices go up. And they are trying to
toilets
move,
are expensive.
Yes, this thing is more than $2 billion to build, and they're trying to move their fans over from the current arena and bring in new fans. And it's a pretty dazzling new venue that they have planned. So they need to pay for that, and they think fans will
helps that the team's pretty good.
Yeah, I mean that's a big piece.
Our thanks to Bloomberg News Business of Sports reporter Ira Boudouet and Bloomberg's Joel Weber, who is moving on to become the head of Bloomberg Explains here at Bloomberg News. More of that in the weeks to come.
Looking forward to that, too. Steve Ballmer, by the way, spending big on his new arena for his LA Clippers. You just heard about that. Steve, of course, a former CEO of Microsoft, which, by the way, was among the mega cap tech companies, those magnificent 7, reporting earnings this past week.
David Kirkpatrick, founder and editor-in-chief of Techonomy, a media and conference company that focuses on tech, and Bloomberg Intelligence senior tech industry analyst Mandeep Singh joined us to talk about the results from both Microsoft and Alphabet, which reported the same day. Mandeep kicking it off on the company formerly known as Google.
Search had a slight miss when you look at the top line number, but it was sort of expected given, everyone was talking about how the competition from ChatGPT will have an impact on the volume. I feel on the cost side, there are puts and takes. Clearly, they have brought down the cost through the layoffs, but when you look at the cloud numbers, that have actually done better than expected.
But is it under pressure from ChatGPT? I mean, are people using ChatGPT the way that they use Google Search? I mean, ChatGPT it doesn't provide the same service as Google Search.
It doesn't, but think of the volume growth, right? So for search business to grow double digit, you need both volume and ad pricing. We know ad pricing has been declining for the past 6 quarters, not just for Alphabet, but for everyone in the industry. So you need that volume growth. And I feel in this case, you're not seeing that volume growth because it's not just ChatGPT. There are other competitors that are building on top of that GPT stack and really trying to disrupt search here. Amazon and TikTok, they were doing it, but now there is even more competition on the search
side. And search in the ad business is so important to Alphabet. David Kirkpatrick, come on in on this.
It's interesting. Both companies, Microsoft and Alphabet, the CEO's statements are raving about going into the AI age. And yet I don't think in either case, certainly in Alphabet's case, we are yet really seeing that much impact on revenue and profit from AI. That's still to be seen.
So let's flip to the other big report that we got was Microsoft. Revenue topping estimates, cloud growth disappointing some. Second quarter cloud revenue was 33.7. The estimate was for 32.21. Revenue overall was a little bit better. What do we need to know? What jumps out for you when it comes to Microsoft specifically?
I mean, Microsoft is the great execution engine of the technology industry, is my basic observation. A $3 trillion company with $220 billion in revenues growing at 16% roughly annually. I mean, these guys are just executing superbly. And, I think that their partnership with OpenAI really has proven to be one of the most brilliant marketing efforts in technology's history, whether or not it does have any concrete short-term profit and revenue implications. I mean, I think Satya Nadella is probably the greatest CEO in global business right now.
Why do you say that?
I just think that he is managing to take that company at its vast scale, unprecedented scale, and continue to point it toward the future in a way that is incredibly intelligent. I mean, cloud is the future of business. You know, AI-infused cloud is the future of business. They are brilliantly positioned. I mean, it wasn't that long ago that Amazon essentially overwhelmingly dominated cloud. And now we have to talk about Amazon and Microsoft, and even Google is creeping up, Alphabet creeping up there.
Let's go to the analyst call. Number one question that you would put to the team over at Alphabet on the analyst call, what you would ask Sundar Pichai.
When will you see revenue improvements because of AI? Okay, you've got Gemini. You've come through this challenging period where people said you didn't get it. Now you apparently have gotten it. Does it matter? That's the key question, I would say, if I were an investor, especially buying at these valuation levels, because they have to show something dramatic going forward to justify their value.
Any thoughts about the great chip race that's underway, it feels like?
You know, I certainly don't write AMD out. I mean, they are not NVIDIA, but they are as close to NVIDIA as any company right now. Although from what I hear, even Intel is coming up with some interesting improvements that might help them in the AI universe, which is just again, defining everything. Everything has to be seen through the lens of the AI battle now. You know, I've seen AMD go from the most beleaguered company when I used to be at Fortune back in the day to a company that really is of great, exciting interest to all of us for good reason.
It's fascinating. Hey, David, thanks. It's been fast and furious, but we really appreciate it. David Kirkpatrick is founder and editor-in-chief of Techonomy.
You're listening to the Bloomberg Businessweek podcast. Listen live each weekday starting at 2 p.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business App. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
I'm just going to say, whoa, what a difference 24 hours makes, or 48 hours. Because, again, just to rehash as we did on our way out with our TV colleagues, you've got Meta up almost 9% here, Amazon up about 4% in the aftermarket. Very different, as we were breaking earlier in the week, Microsoft and Alphabet, right? It was just very, very different.
Yeah, Meta boosting its buyback by $50 billion.
It's massive.
Sees first quarter revenue between $34.5 to $37 billion. The estimate was for $33.64. Paying a quarterly dividend of 50 cents per share, so returning money to shareholders. Carol, it's pretty remarkable to see. I want to get to James Chalkmark. He is a partner and technology analyst at Clockwise Capital. Look, we have Amazon results, we have Meta results, we're getting Apple later. James, this is pretty blowout quarter for Meta Platforms. That's where I want to start. What sticks out to you?
What is that the cost advantages that we saw over the last year that they've been implementing are more sustainable than people expected. Obviously, the top line is firing on all cylinders, really not seeing any kind of cyclical impact to that business as of yet. But all told, you know, the earnings picture looks a lot stronger, and I think you're going to continue to see productivity improvements operationally to boost earnings as we go forward.
All right, flip on over to Amazon. We're just doing a quick touch first initially on these two. Amazon's up about 3.3% in the aftermarket as well. What is it that kind of impresses you about their release here?
Yeah, I mean, the main thing is on the improvements in the margins. I mean, this is something that they've been working on for the last year, really getting logistical efficiencies and optimizations and leveraging the AI to add predictive supply to different regional fulfillment centers. So that's all playing out. The one question that we had going into this quarter was how much of that bore fruit in the fourth quarter, because it's their kind of first big holiday quarter with the optimizations in place. So we were unsure about that, but more so optimistic on the go-forward outlook. But I think you're going to continue to see momentum. I mean, this is a company that's, you know, over 50% of every new dollar that goes online, they capture. Wow. They have all these new levers with, you know, advertising. Now they're the third largest ad platform in the world. And, you know, a lot of these things aren't talked about. The revenue that's going to flow through on the ads that are placed in Prime Video, are just going to trickle down to the bottom line. So you have so many levers in this company. You really want to look at it more on a sum of the parts basis, obviously, but the street doesn't do that. On a sum of the parts basis, AWS by itself is over $1 trillion.
We want to go back. No, go ahead, please.
Yeah. No, I mean, so basically, I mean, this is a company that we think has a tremendous amount of optionality potential to it. So the way we invest is how predictable is the revenue and margin outlook, and how much optionality is priced in or not priced in.
I know.
So based off of that, Amazon's right up there.
I know all of these, we lump all of these mega cap tech companies often together, but they're not apples to apples.
Sure.
I get it. But it just seems such a different tone here, watching how the shares have reacted right after earnings, and you've got Meta and Amazon shares soaring. Yet I go back to Microsoft and Alphabet earlier in the week. What's the difference? And again, not apples to apples, but I'm curious how you are thinking about this sector overall and these names.
Yeah, I mean, the so-called Mag 7, we kind of view it as just three companies now. It's Microsoft, it's Amazon, and it's Meta. The other ones, we are overweight those names and underweight the other four, because at the end of the day, it comes back to the predictability and the optionality. Now, Microsoft, I think, was just a bad luck with a bad tape. With Powell certainly didn't help yesterday. So I think that wasn't a warranted kind of reaction. It should have been flat to slightly up. But Google, they're a mature company. You're not seeing the growth levers as strongly as the other three.
Hey, James, to Meta Platforms briefly. Is Meta Platforms still a metaverse company, or has Mark Zuckerberg decided, okay, we wasted enough money on the metaverse and we're investing in AI in our core product?
Yeah, I think it is. I think the world is moving in that direction. I'm optimistic about it as an investor.
The metaverse?
Slightly worried about it. As an investor, I'm optimistic about it, but as a constituent and citizen, I'm nervous about it.
The metaverse, that is, right? I just want to make sure we're talking about the same thing.
Metaverse.
Okay.
Yeah, living in a virtual world, never meeting people again, basically.
Yeah, I would miss you if that happened. But you're not concerned about it as an investor. You think that the money they're spending on the metaverse is the right direction.
Yeah, as long as it's a predictable value. If we have, they increase their investments by 10x. Out of the blue, obviously that throws a wrench in our assumptions. But as long as they're investing steadily and in a measured way, I think it's improbable that the world does not go in that direction, and they're at the forefront of it. Obviously, it's going to take time, but who better to be ready for it than Meta.
Hey, listen, I got to mention, because this is just crossing too with earnings, Microchip Technology, of course, a semiconductor device company. And this one is dropping in the aftermarket. It is down about, let me just bring it up here for everybody, down about 3% here. And this is what the company is saying. First of all, it sees fourth quarter adjusted EPS 46 to 68 cents a share. You could drive several trucks through that. The estimate on the street is way above that 92 cents. It says it's going to have 2-week shutdowns in fabs in the next 2 quarters. So we talk about cycles. So it sounds like some shutdowns there. Fourth quarter net sales, $1.23 billion to $1.43 billion. That too is quite a range. The estimate on the street is above that at $1.67 billion. I just wonder if you have some thoughts on the chip sector, which we keep, it feels like it's piling on some of the negative tone here.
Sure. I mean, our top ideas right now are NVIDIA and Supermicro.
Supermicro's been on a fire for several years.
I mean, we bought that at 283, so I can't complain. The fact of the matter is we kind of look at this AI and this whole semi market in 3 buckets. Bucket number 1, which is the most near term and the most resilient and robust growth, is going to be AI infrastructure, building out the data centers, the servers, and all the components that go into it. All the CapEx that we talked about, all the fears with Google, Amazon, Microsoft spending on CapEx, these are the companies that are supplying that. So that's what the second tier is, the companies that help you design the chips and adapt those chips to AI, like a Synopsys. And then the third tier would be the software, AI-based software services like a Snowflake. So we're leaning heavily into the AI infrastructure side of things, and we think that the other part of the semi market and AI software market will be more of a 25 story.
All right.
Go ahead.
Well, I was going to say, do not go anywhere.
I was just going to give an update. Meta Platforms up 12.5% in after hours right now. Still waiting on the call here from Mark Zuckerberg and other executives. Shares of Amazon right now up by 3.8%, and we're still waiting Apple to report.
I got to say on Meta, I'm looking at our live blog that's breaking it down. Our Kurt Wagner, who follows a tech reporter, he says, how efficient was the year of efficiency for Meta? He says headcount was 67,317 as of December 31st, a decrease of 22% year over year.
That's a pretty good way to get earnings up.
Bringing it down. And that buyback, additional buyback authorization of $50 billion, and then also tossing investors a dividend. That is pretty remarkable. Not that, what?
There's also some news about the actual metaverse in this.
Exactly.
Very deep in this, Carol.
Go to it.
The company is going to continue to lose money in Reality Labs. It's the division that makes the metaverse technology. But here's a bright spot for Zuckerberg, as our own Aisha Counts points out on our live blog. His VR ambitions, that is, quarterly revenue in Reality Labs crossed $1 billion for the first time.
Yeah, so maybe it's starting to contribute.
It's an incredible quarter for the company.
All right, let's get to it. James Chalkmock sitting by, partner and technology analyst at Clockwise Capital. We've also been talking about Amazon, which is also up about 4 or 5% here in the aftermarket. It reported strong profit, gave an operating income outlook that surpassed estimates. Again, talking about, Charlie mentioned this, CEO Andy Jassy's unrelenting cost cutting and focus on services that make money is reshaping the once free spending company. Yeah, it's a little bit different perhaps under Andy Jassy, but nonetheless, James Chalkmock, we're waiting for Apple. You've had a little bit more time to think about these results. Go back to Meta. It's been on a tear for a while. As we said earlier, I mean, it's doing better than Apple has been and Amazon this year. What is it about that Meta story that you think all of a sudden their focus is right now?
Yeah, first I say with all these dividends and buybacks, it's like these tech companies are becoming the new Dow component. As far as Meta is concerned, I think one of the best things that could have happened to them was the Apple's privacy changes, because that absolutely destroyed them. Where in the sense that they could not target users in the way that they used to, and Apple obviously preferred their targeting capabilities over third parties. So. But what that enabled them to do was actually come out stronger on the other side of it, where they retooled everything and improved targeting capabilities and essentially increased the span of the walled garden that they have, and in that process, I think has increased their competitive positioning versus smaller scale ad companies that couldn't adapt fast enough or didn't have the resources to adapt. So I think it just made them stronger at the end of the day. And I think as we look forward, it's going to be very difficult for them to be derailed as far as the top line is concerned. And when we think about the overall value of the company, I think it's conceivable that next year we could be looking at $20 in earnings, and at a 25 multiple, that puts you at $500. And potentially there's upside to those numbers here. And that's when it comes back to what is the base case? What is the optionality? Base case, I get 500.
You mentioned, James, other smaller companies. Snap is a company you followed for years. It's been under pressure lately, but it is up 6% in the after hours in sympathy with Meta Platforms. What do Meta shares tell us about what Snap could report?
Yeah, I just don't really care for Snap anymore. I think they haven't found their niche in the manner in which I originally thought that they would. For smaller tier players, I like a Pinterest, for example. I think they really have their DNA set on the inspirational social feeds and increasing their presence on the commerce side of the equation. So I'm looking at more companies like that. Now, we sold out of Pinterest because it got ahead of our valuation targets, but it's companies like that I think can still have a place, but at the end of the day, it's still going to be the Googles and the Metas of the world.
Well, speaking of that, so as we've been talking about Meta, just on a tear right now, it's up about 11, 12% here in the aftermarket, 13%, forgive me. Amazon's up about 5.5%. Obviously, if you bought it yesterday, it was a better timing call. Yeah. But having said that, and everybody says, don't time the market, don't time names, and so on and so forth. Anything, though, in these reports that would say, you know what, I need to take a look. Maybe it's time to allocate a little bit more to these names specifically.
Well, we're already, we run pretty concentrated, so we're pretty heavy. But I would say at this point, Amazon continues to offer the most upside at 225 is kind of where we're thinking it can go over the next year and a half.
That's about a $65 run
Meta,
from here, yeah.
Yeah, and then Meta obviously we think can get to 500, but I think I would own all three. I mean, at this point, kind of we view a full size weight around this, upwards of 6% of the portfolio. So, we don't mind being at max weight on those and letting them run if they, they go north of that, which they will, after tonight's result.
The ETF that you guys have at the Clockwise Core Equity ETF, I should note, NVIDIA is the top holding at 5.3%, then Spotify, Meta Platforms, Microsoft, Amazon, Apple, rounding it out.
Yeah, so you're all in, no doubt about it. Hey, listen, we're watching Apple in the aftermarket. It is up about 0.6%. In about a minute from now, we assume we will be breaking down those Apple earnings. What are you watching out for most in those results?
Obviously, on the guidance, on the iPhone outlook, I think the quarter is going to be fine, actually. One of the things that I think is underappreciated this quarter is the reversal and reacceleration on the Mac side. I think that could surprise to the upside. The street's expectations are pretty modest at 1% growth. So I think the quarter will be okay. I think the big question is going to be, what is that iPhone device outlook for the year? And for the next quarter, but we won't really know that until the CFO's commentary.
Do you think that the China issues are overblown, James, for Apple's iPhone?
Yeah, to some extent. It's hard to say, but we're not relying on massive growth in the iPhone. What we're relying on is no massive deceleration in the iPhone. As long as it's the status quo there, they have other levers okay.
James, hang on, because we've got first quarter numbers coming for Apple, and this is...
It's a beat when it comes to first quarter revenue for Apple. $119.58 billion, beating estimates of $117.97 billion. First quarter revenue for the iPhone coming in above estimates too at $69.7 billion. Estimates were for $68.55. Greater China revenue also missing expectations significantly, $20.82 billion versus estimates of $23.5 billion.
Yeah, maintaining its quarterly dividend at 24 cents a share right now. Apple shares just up about 0.4% here in the aftermarket. We can dig a little bit deeper. iPad revenue, $7.02 billion, a little light, but pretty much in line. The estimate was $7.06 billion. First quarter wearables, home and accessories, $11.95 billion. The estimate of the street was a little bit above that at $12.02 billion. Mac revenue, $7.78 billion versus the estimate of $7.9 billion. And again, going though to what really matters is the iPhone. iPhone revenue, as Tim mentioned, $69.7 billion. That was a little bit above the estimate of $68.55 billion. Again, though, we're seeing Apple down about 0.5% here in the aftermarket. Expenses, total operating expenses, $14.48 billion. That's a little bit light. $14.62 is what the street was looking for. And first quarter EPS, $2.18 a share. That was 7 cents better than what the street was expecting. So that's just the initial reaction. And again, as we said, shares of Apple here in the aftermarket, while Meta and Amazon are rallying big time, we've got Apple shares just now down about 1% here, Tim.
James, what do you think about this? We have a minute left with you. You heard us rattle off some numbers there. iPhone coming in above estimates, and then first quarter revenue coming in above estimates, but a pretty big miss when it comes to Greater China revenue. What are your takeaways?
There could be something to be said about the reports coming out that the China market may see greater competition. But again, I want to wait for the call to make that determination. But the biggest standout from the numbers you just cited was Mac was lighter than I expected. I thought that could reaccelerate. iPhone status quo, or I guess better than the street, but largely status quo, so that's fine. And then the wearables and iPad was already expected to be down. So I think this is a wait and see. It could go either way.
Yeah.
But it's a position that we've downsized.
The company's CFO in the press release saying, during the quarter, we generated nearly $40 billion of operating cash flow, returned almost $27 billion to shareholders. We're confident in our future, continue to make significant investments across our business to support our long-term growth plans. James, be quick. 10 seconds. Number one question on the call for you?
The number one question, would likely be, I would talk about the PC upgrade cycle. Their view on, the timing of that, and if this is indeed a 24 event.
All right, really appreciate it. James Chakmak over at Clockwise Capital.
You're listening to the Bloomberg Business Week podcast. Listen live each weekday starting at 2 p.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business App. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
All right, Tim, we are all familiar with Dry January. I know that's an easy lift for you since you are a fan of non-alcoholic beers and drinks. Would it also be so easy to consider a digital detox? That means putting down your smartphone.
I think it is fair to say that. I don't know if our jobs in this day and age sort of allow us to do that for at least an entire month. It is an interesting challenge, though, especially from the folks over at Siggy's Yogurt. We spoke to the chairman and founder of the company, Siggy Helmarsson, about where the idea for the contest came from.
Well, I think the idea is sort of, connected a little bit to the brand in a way. So our sort of philosophy when I started the business like many moons ago was to strip away all the stuff that we saw in yogurt, which is like a lot of ingredients. So like our sort of tagline was simple ingredients, right? And we see a lot of that today in people's behavior with their phone. They sort of are addicted to it. And a lot of it is maybe not stuff that's useful. It's like very hard to be without your maps, for example, when you're navigating a new city. But do you ever get an itch to look up maps, right? But you do get an itch to check stuff that sort of you don't necessarily need in the moment. So I think the sort of idea and how it's connected to the brand is sort of to strip away the sort of the non-essentials of what you don't need in your life right now, and sort of putting away the phone for a while and see how you do is one of those things.
Well, part of us loves it. Part of us is terrified.
I'm dreaming about doing that.
We want to continue with this. So you're talking about this digital detox, and I think it's kind of interesting, this idea, almost an attractiveness towards simpler times.
I didn't mention the $10,000, by the way.
No, and right, there is a competition.
Yeah, a little bit of an incentive.
Yeah,
right?
Pretty good incentive. Not just free yogurt.
Not just free yogurt. Well, there's a little bit of free yogurt as well.
But
there's
not
a 3-month
just
supply of free yogurt too. But $10,000 free yogurt,
It catches people's attention. And I think, what's interesting, it's stuff like this that makes us kind of think about our environment right now. And we talk so much about the role of technology and how it consumes us. We're also kind of using technology as a great, kind of clues, sometimes data collection gives us an idea of kind of what the environment is like. And I want to just go there if we can for a moment, just coming off that headline. How do you see the business environment right now? How does it feel to you?
Well, at least for Siggy's, we've been doing great in the last few quarters. Business is up like a little close to 3 times the categories, like around 6%, categories up around 2%. So business is doing pretty well for us. We sort of see still a strong interest in our offering. We see a lot of the sort of hiccups that we went through, like everybody in COVID, fading out, like supply chain issues, on anything from freight to cardboard was a huge issue during the pandemic. We also saw some of the sort of changes in the consumer settle that, like for example, the desire. We had a lot of single serve business, and we saw that graduate a little bit more to like family sizes during COVID,
going out,
as people are not sort of on the go, going to the office. Obviously, that has since picked up a little bit because of office openings again.
What about raw materials costs? Not cardboard, not containers, but dairy. I mean, we're off of the highs from COVID when it comes to dairy prices, but they're still elevated.
Yeah, there's still some of those cost pressures are not going to go down, but we see a lot more sort of more balanced environment.
Well, and it's interesting, too, in terms of your environment, and we talk about the first time we talked, you guys had just been acquired. This was back in, I think, 2018.
Correct.
The French dairy giant, Lactalis, I think I'm hopefully saying it correctly.
Good memory.
But I'm just curious, as your business, which you began back in a New York City kitchen back in 2005, how it evolves, grows, what kind of, stands out for you in terms of that process and how the market changes, consumer demands changed? What's changed?
Well, the biggest thing that obviously changed for Sirius since the acquisition was, we're now international, which is a lot of fun. So Sirius is not just a U.S. brand. It's doing phenomenally in France. The sales team there has done an amazing job, and Canada, Australia as well. So that sort of stands out for me personally. But in terms of what stands out, like the market as a whole, is that when I started, yogurt in America had crazy amount of sugar, right? Mm-hmm. Like the best-selling yogurt at the time when I started had 28 grams of sugar per cup. That doesn't really almost exist anymore. So everybody has come down. So for us, that's obviously great because we sort of feel like we moved the needle a little bit on the market.
But it's more competition.
So it's sort of like a blessing in disguise a little bit. But we are still the only one that sort of offers what I call the complete package, which is that lower sugar, clean ingredients, and higher protein and better texture. So there's a lot of people who sort of copy one element of our strategy, but nobody who offers this sort of trifecta of all the things that are good for you, I think.
How are you thinking about brand innovation in a category that has, as Carol mentioned, no shortage of competition? Like, where's the white space right now for you?
Well, we think like the drinkable yogurt space is pretty exciting. So we're coming out with some new innovation there in the coming months and years or quarters. Maybe that's like, since we're here, we should say quarters. But so I think that's pretty exciting. And we're revamping some of our older drinkable yogurts that have been doing well and been on the market for a while. So we see interest there. But you are right, the competition is pretty fierce.
I think it's interesting too, because, we talk about whether it's becoming more sustainable, making that so that works with the cost side of the equation. But what you talked about, how in terms of yogurt, it's really shifted in terms of ingredients, becoming much more healthy. Do you feel like increasingly consumers, we talk about it, it's certainly a priority for me. I know it's a priority for your family. It's obviously a priority for you and your company. But you increasingly see consumers demanding, they're turning it around, checking the ingredients. They want cleaner products.
100%. I mean, there's like a day and night when I moved here, and when I started the company about 15 years ago, is that people are so much more savvy. And not only do they do what you say, they look at their ingredients. They know even some of the more esoteric ingredients that people use. So, that's sort of still our claim to fame. We're one of the few brands that only uses, for example, just fruit. We don't use flavorings. So people notice that kind of stuff.
Okay, 10 seconds. Is there another thing from Iceland that you could bring to the U.S. that you think would be successful?
Well, I think the dried fish is delicious, but I don't.
You're not talking about the buried shark that ferments underground, are you?
No.
Because that is not delicious.
That is still quite moist, but
okay.
I love the dried fish. I eat a lot of the dried fish when I go home. I love it with a little bit of butter.
Is that the next company?
Sorry, I don't know. I think that might be a tough sell for Americans.
We got to run. Good luck with the contest. Siggy Hilmarsson, of course, chairman and founder of Siggy's Yogurt, right here on Bloomberg Business Week.
You're listening to the Bloomberg Business Week podcast. Catch us live weekday afternoons from 2 to 5 p.m. Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business App. Or watch us live on YouTube.
Because I'm hungry for those good things, baby.
I'm always hungry.
This is like your theme song.
Okay, so full disclosure, Carol just gives me the hardest time because I'm literally always eating.
Always eating. I look over, and this guy is like as thin as can be.
Well, I'm always looking for any excuse to make food part of our program, part of our show.
I know. Just like I'm always looking for wine to make part of our show.
Yeah.
You're always looking.
Hey, it's yin and yang. It works, okay? To that end, we got Norma Chu with us. She's a financier turned culinary entrepreneur, formerly the head of HSBC Private Bank, who decided after a few years of banking to make her pivot and start Day Day Cook. It's now a publicly traded company with her at the helm. She joins us here in the Bloomberg Interactive Brokers studio. Norma, welcome.
Thank you for having me, Tim. It's really glad to be here.
Well, you've got a really interesting story. So before we get into, talking more about what exactly you're doing day to day, just give us the big picture and how you ended up leaving banking to become an entrepreneur.
Wow. And that takes me back 13 years ago when I first started the company. growing up, I've always had two passions, which is the stock market and cooking. I grew up watching the Bloomberg, CNBC. And so after graduating from UW, I grew up in Seattle. I was in investment banking for a couple of years and then got into equity research. But moving back to Hong Kong, I then realized a lot of my friends didn't really cook. And for me, growing up in the US, I really enjoy cooking. Cooking has always been a big part of me connecting with my family and friends. So I wanted to create something that promote cooking for future generation. And so I started Day Cook. And in the beginning of the business, we really focused on creating short form video content, promoting very easy to follow home cooking recipes. And over the years, we kind of following that mission to promote Asian cooking culture to the world. We started as media and then later on doing media content commerce. And a few years back, I decided to launch private label branded products. That's kind of the evolution of the business to date.
There's so much competition out there, and there was a period where I felt like there were all these different types of food services that, would teach you how, provide the products and so on and so forth. How do you kind of find your niche in that space so that you could find a sustainable business? I mean, you've been doing it since 2012. So what has been your approach to kind of keep the business going, keep it sustainable?
I think it's really just, being open-minded and being aware in terms of what's happening out there, what's happening in the industry and with our consumers, and having a very positive mindset. Competition, I think, is everywhere, and as long as it's an industry that is attractive, there's going to be competition. But we see it as a positive light. The more people that come into the space, we're going to grow this space together, and really look at it from a collaborative manner, and seeing this opportunity and really acting on it. So, for example, even though we started Day Cook in Hong Kong, then into mainland China, back in 2022, I decided to start venturing and looking into other opportunities elsewhere. And really coming back to the US that year, I really realized, wow, there's a huge demand for consumer looking for convenience meal solutions with a focus in Asian cuisine. So I thought, okay, that's a great opportunity. How can we take advantage of it? And so I started talking to people in the industry, and later on really meeting some very interesting founder in the space. So I got to know Nona Lim, which ended up a few months later became our very first acquisition here in the US market. And now, a month ago, we also completed our second acquisition here in the U.S. So I think that's just an example of, being open-minded and aware of what's happening, seizing opportunity with a very positive attitude.
So where are you doing production here in the U.S. in terms of actually creating the meals, getting them out to and they're available.
The co-packers, right?
Yeah, they're available in grocery stores around the country. But where are you doing the manufacturing?
So all of the products are mainly made in the U.S. right now, and then we have some international co-packing partners. So under the Nona Lim products, we have some products coming in from Singapore, and recently we also helped on the R&D and product innovation side of things, and we launched some new clean label cup noodle products coming from mainland China. But for now, most of the products are really made in the U.S.
How profitable is it? In other words, what is it? I don't know. What can you tell us and share? We're Bloomberg. We're so into it. You said it kind of grew up or watched certainly Bloomberg and some of our competitors. But how profitable is this business? Are you profitable?
Yeah. So we announced our third quarter 2023 numbers last Friday. So we have been EBITDA positive for 2 quarters now. The markets shift, and investor also the focus also shifts sometimes. And for what we see in terms of trends, in terms of managing fast-growing food companies, growing profitably has become really important. I think maybe a couple years, maybe 3 to 5 years ago, growing at all costs was kind of the trend.
Correct.
But in the past 2-3 years, most of the founders that we talked to, including ourselves, including myself, the focus has really shifted to creating products that have healthy margins and finding distribution partner and channels that's sustainable.
Right.
That's really the key here, and that's what we're doing, and that's who we're looking to continue to partner with.
It's so interesting that you ended up IPOing back in November of 2023. So you've only been a public company for a few months at this point, but it's so interesting that you took the public company route because in the space that you're in, oftentimes what happens is a huge CPG company would come in and buy you. And we see that, with Siggy's yogurt, for example, or Justin's peanut butter, for example. Why was the IPO the right route rather than getting gobbled up by a bigger company?
So I truly believe, even though I've been doing this for 13 years, this is just the beginning of how I want to build and grow this company. A couple years ago, I decided to start this go public journey, and it's been a very rewarding path so far. And the thought process really is about finding the right platform, taking the company to the next stage to allow us to grow through acquisition and buying more brands. And instead of being bought out, my view is what we're creating here, I want to build a cross-generation company. I want to become, for example, the General Mills for Asian cooking, if you will.
Wow. So you're going to stay in that vertical,
yes,
right?
That's right. We want to be very focused, continue to attract more quality brands in the consumer and the convenient meal solution space with a focus on Asian cooking.
Direct to consumer, do you do any, or is it all you're going to find it in stores?
Right now, most of our brands are available in stores. We do a fair amount, a smaller portion in direct to consumer. Current limitation is really at the product format. So, for example, Nona Lim is mainly, traditional retailers because the product format is chill and frozen.
Got it.
But now that we've launched shelf stable, it's a lot more flexible.
What's the top line growth?
Crop line growth, we are, it's very attractive, and we're really exciting about all these
Doubling
opportunities.
the business in the last year? Like, what can you tell us in terms of that?
Some of the brands that I'll give you, maybe I'll answer the question this way. Right now, we're still, in the high growth state, and then we are looking for a lot of partners to join the platform now that we were newly listed. And some of the growth criteria that we look at least minimum, around 20% growth. Of course, that varies, right? If we talk to the smaller brands, they're starting out, still have a lot of upside. The growth we could be looking at 40-50%. But if we're talking to a potentially bigger, more influential and established partner, then 20% really makes sense.
You're based in China, but you're traded on the New York Stock Exchange. Is there any chance that you would move the company headquarters back here to the U.S.?
I think, we are having an open-minded discussion right now amongst the management team. So it's possible that, we relocate the business and the headquarters elsewhere, depending on the shift in the revenue mix in the next, 2-3 years.
So it would depend on the revenue mix of geographic revenue mix?
That's right.
You are in New York. Benchmark just today initiated coverage at a buy with an $8 price target. We did mention the stock, right? Popped today.
6% today.
6%. 30 seconds left here. What is it that the analyst community most kind of press you on?
I think, for me, it's just really focusing on executing on our growth strategy. We're newly listed. It's time for me to stay focused on the business and deliver on what we say we're going to do, which is growing internationally and expanding our multi-brand product portfolio.
What's your biggest market right now?
Biggest market is still the mainland China market.
Mainland China. What do you think will be in maybe a couple of years your biggest market? Still mainland China?
The highest growth right now is in the U.S., and I would put my bet in the U.S. market.
All right. Really interesting stuff. So stay in touch. We'd love to hear more as you continue to move on this journey. Norman,
thank you so much.
Yeah. Founder of Day Day Cook joining us here in our Bloomberg Interactive Broker studio.
You're listening to the Bloomberg Businessweek podcast. Listen live each weekday starting at 2 p.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business App. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
What do you think of when you hear the names Sean Combs, Puff Daddy, P. Diddy, Puffy Love? I mean, there's so many names, Tim.
Well, whatever you call him, 2023 was a bad year for the hip-hop mogul. He was accused by multiple women of sexual assault, released his first solo record in 17 years to not-so-great reviews, had a $185 million deal for a cannabis company fall through, and after months in court, Sean Combs withdrew his racially charged lawsuit against alcoholic beverage company Diageo.
Bloomberg Businessweek senior global business writer Devin Leonard covered the fall of Diddy Inc. and 2023, the year that was.
He went into the year, I guess, assuming that he was going to close this deal to create the largest black-owned cannabis business in the world. That deal fell apart. He nosed around, BET, saying that was when he was going to create this great sort of black-owned, media empire. Paramount Global pulled that off the market. He released his first solo album in 17 years. It was his worst performer. It went to number 18 in the Billboard album chart, but this is a guy who's had all these number ones. It didn't even crack the top 10. And then he was in the midst of a huge battle with with Diageo over Ciroc vodka and De Leon tequila, and Ciroc I think has been his biggest moneymaker in recent years. And then as we saw just recently, that fell apart too.
Talk briefly about how the deal came to be. I mean, years ago, when he at a different time, and how it propelled him to billionaire status.
Yeah, it was just crazy. I mean, but he was really hot in 2007. There was a woman I spoke to. Her name's Barbara Lee. She worked at Diageo. She was head of multicultural marketing, and she went to his white parties, out in the Hamptons. But she thought, this guy's sort of the ultimate party guy. Let's sort of make him the face of Ciroc vodka, and it worked. I mean, they went from a very small number, of cases a year, ultimately to, I believe it was 2.1 in 2014. But basically, he took this sort of a nothing vodka and sort of put it on the map. And in the end, he was making $30 a case, on U.S. sales, and so it's a lot of money.
But he was not happy about that.
Well, Tim, what happened was that...
Here, come, Tim. Let me tell you a story.
Is it because of George Clooney?
Diddy wanted more money.
Is it because of George Clooney?
Well, he got Diageo to go in 50-50 on a tequila with him, and then Diageo went on to buy. It was called De Leon. It was this really high-end tequila, but it didn't do all that well because he and Diageo started fighting over who was going to put money into it. Diageo says he never put any money into it at all. Then, meanwhile, 4 years later, that's 2013. Flash forward to 2017, Diageo buys Casamigos from George Clooney and his partners for $1 billion, and to hear Diageo say it in court records that I guess Diddy wanted that kind of money, and he started threatening to go public with racism allegations, and which ultimately he did. But and the whole lawsuit's sort of a crazy story in and of itself. But what he ran smack into was all these sexual harassment suits were filed in November, and then just earlier this week, and that basically meant. He had Al Sharpton, threatening to boycott, Diageo, and that kind of thing. He was trying to make this whole thing part of this big, sort of racial crusade. And unfortunately, once 4 women accused him of sexual assault, he didn't really have any moral standing, and he withdrew the lawsuit this week and gave up Ciroc and De Leon. Now he might have gotten a payout, but that's not really. He didn't get $1 billion, and his name is, pretty much worthless at this point.
Yeah, it's pretty rough. I mean, but Devin, we've got about 2 minutes left here, and I'm just wondering, this was, he was really successful at a lot of stuff. So what happened, or how, as you guys went through this story of kind of, where he is now and how it all came undone? Like, what happened?
Well, I mean, I just think at some point he lost his heat. He was never really, that great a rapper or that great a producer, but he had this great success, with Bad Boy, back in the 90s, and then
John.
Yeah, well, no, and then he uses that to sort of spin himself off as an artist. He creates Sean John. That was a very successful thing for a long time, but Bad Boy cooled off. Sean John, he sold it. It went bankrupt. He bought it back, but he just hasn't done anything with it. Meanwhile, he's got this Revolt TV that it's very hard to get numbers for, but S&P Global estimated that they're really not making that much money, and they don't have that many subscribers. Ciroc was really, I think the cash cow, and so he lost that too.
They were together for a long time.
Yeah. Well, from 2007 on. So, and again, Diageo asked, when he sued them, Diageo was like, "Whoa, wait a minute, we paid you $1 billion, over the years. What are you complaining about?" But he doesn't have that anymore.
That was Bloomberg Businessweek senior global business writer Devin Leonard. Check out the full story on the downfall of Diddy Inc. on Bloomberg or online at bloomberg.com/businessweek.
Now, P. Diddy has his roots in the music industry, even won 3 Grammys. Coming up, the 66th Annual Grammy Awards, with women dominating the top nominees this year.
Many would say that's progress for an organization once criticized for its lack of diversity. This year, 7 of the 8 finalists for Record of the Year and Album of the Year are women. And yes, Carol, Taylor Swift is a finalist for both of them.
We know this. It's Taylor's world, and we're just living in it. All right. With more on this Sunday night's event, we caught up with Harvey Mason, CEO of the Recording Academy. It's the organization that oversees the Grammy Awards. Now, he in his 4th year running the big show.
It's definitely unique. Since COVID, there's just an appetite. There's a hunger for live experiences, and I think music has been thriving because of that. But as you said, it's not just Beyonce and Taylor. Thank you. They had great seasons, great years. But it's also the other touring, working musicians, the people who hang the lights, the people who set the microphones and work the soundboards. There's so many music people associated with big tours and small performances. So venue owners, think about all the different people that are in this ecosystem. We're just thankful that we're through COVID and we're able to enjoy music. And what I like most about the live shows, whether it's the big massive arena tours or intimate stages, it just brings people together. It gets people to sing and nod their head and feel good and share a human experience. So happy to be doing music right now and involved in the environment.
Hey, well, talk to us about the environment for award shows. It's gone under some difficult times, whether we're talking about the Oscars or the Globes, in terms of diversity issues and just kind of being more relevant in terms of what is going on more broadly at the world. I feel like music, to some extent, often is more in tune to culture, but it's had its own rough moments. How do you think about it as you approach this year's Grammys?
So much to unpack there. Actually, it's probably a 10-minute response I'd love to give you, but I'll start with the work we've done over the last 4 years around our membership. We're 24,000 members. We've totally rethought and overhauled who our members are. We're now at almost 40% people of color. We're at over 30% women, which is totally different than we were 4 years ago. Our awards and the diversity around that and the representation has changed. But to your point of making sure we're relevant, it means listening to what's going on in the music industry. It means listening to our creators, our members, and them telling us, we can't sit back in a room and say, okay, we're the Academy, we're going to do this and this and this. We have to make sure we're representing the music people and we're listening to what's happening. This stuff moves so fast. As you said, music is driving culture. In order to keep up with that, we have to make sure we're paying attention. We're inviting the right people in to share their knowledge and their experience. It could be as small as one genre saying, Harvey, you and the Academy are totally missing this. Let's make sure we get a new category, which is great because we've done 3 new categories this year.
Which is very cool. Who are the right people? When you say that, what does that mean?
The right people are the professionals in those different groups of music makers, whether they're songwriters, producers, engineers, but there's all these different genres, and it's also more complicated because genres are blurring and people are coming together. But reaching out into the different areas, geographically speaking, gender speaking, genre, and making sure that we have information coming to us from all the different constituencies.
Hey, how do you make the show, the actual Grammy Awards, more relevant in terms of viewers, in terms of getting people to tune in? I'm just reminding myself, we learned earlier this month that a new low in terms of ratings for the Emmy Awards. So people are definitely getting their content other places. The award shows are not attracting the audience that they used to. How do you change that?
Well, we're actually trending the other direction. We were up 30% last year, and we continue to grow our audience. But it's an interesting point, something we have to consider. Consumers aren't necessarily always watching linear or traditional television. We have to make sure we're going out to where people are absorbing their content, taking in their content. That could be digital, that could be socials, that could be streaming, and we're doing all that. And we're really happy and proud that our engagement is higher than it's ever been. More people are taking in the Grammys and the music-related content than ever before.
Yeah, it's interesting. I was thinking about the Super Bowl.
Which part were you thinking about, Carol?
I was thinking about Taylor Swift.
It'd be a big one.
Well, it's so funny. We did this whole story about the Taylor and Travis combination, and folks have done some calculating of kind of that brand and the impact it's having on the NFL and the Super Bowl coming up a week after the Grammys. But I mean, when you think about the brand that is Grammys, what do you hope people think that it is?
Well, initially and on the surface, we hope people really enjoy the show and say, wow, that was incredible. I saw something on stage that blew me away, or I'm so amazed. But my hope in our messaging, and the more I reach out and talk to people, I would love it if they would understand what the Academy does, the other 364 days of the year, which is advocate for music people, make sure they have a safe and healthy ecosystem to operate in. We are doing Music Cares, our health and human services organization. We gave out over $35 million during COVID. And then our museum and the education, the preservation of music, making sure the next generation of people like me or like our members have music at their fingertips to make sure they're learning and understanding it. So it's a wide range of things we do at the Academy. Yes, the Grammys are here. It's exciting. It's amazing. Please enjoy it. But also know this is a not-for-profit organization that does everything within our power, within our mission to serve and uplift music.
I love what you said. And there's so many, you started off the conversation about all the people behind the scenes and often the musicians. And I think about years ago, I was in college and our college radio station was all about jazz here in New York. And the jazz musicians who for years were never paid. And there were a lot of them that were homeless. Like, it was really upsetting. And I just think about, being an advocate for those who are behind the scenes, right? That aren't necessarily the front singer, if you will, or what have you. But that's a really important part of this.
And knowing your audience, Bloomberg, I'll talk a little bit about that, making sure that musicians are paid fairly and there's an equitable system for royalties and ownership of intellectual properties, whether it's the jazz musician who's working, a day-to-day gig job somewhere, or it's a superstar and all the team that works with them. We have to make sure there's legislation in place. We're advocating federally and locally for, laws and things to be passed to protect the art form and protect the work. That's very important. And then, as I touched on, music cares. When a musician is falling on hard times, do they have a safety net? Do they have somebody that they can call for support, for help, financially or otherwise? And so that's what I'm proud about at the Academy. We've been doing this for 65 years. We've had ups, we've had downs. People have been happy with us, they've been angry with us. But what's been consistent that we have not missed is the opportunity to serve our music community, and we'll continue to do that.
Hey, Harvey, I just want to end with kind of people understanding more of how you do things, because I'm kind of still in awe of everything that you're able to do, not just as CEO of the Recording Academy, but outside of that job. How do you make sure that you're dedicating enough time to your CEO position, but also pursuing these projects, including songwriting, producing, and then also working on these films?
Well, that's a delicate balance and a good question. I don't know quite yet how I do it myself. I spend a lot of time juggling. I do the CEO thing pretty much all day, every day. And then the evening comes to, the music comes to me and I can get into the studio and create. So it's a juggling act. My kids are growing up. I don't have pets. I don't have any hobbies. I love to work.
I love that. Is there any AI involved? Just got about 10, 15 seconds.
AI is definitely involved. AI has always been involved, not always, but in the last 10 or so years, it's been involved in how I make music, how people write, how people create, and it's going to continue to go that direction. We have to make sure we're figuring out how to put some guardrails around that and protect the human creative community.
It's a really good point. Hey, listen, we're looking forward to the Grammys, and thanks for finding some time for us. We know you're really busy. Harvey Mason Jr., Chief Executive Officer of the Recording Academy, as we said, oversees the Grammy.
This is the Bloomberg Businessweek podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live weekday afternoons from 2 to 5 p.m. Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business App. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.